Okay, before we head into this week's market outlook, an update for the applied level. One part, the applied asset management under screeners, you'll find the momentum screener up, and this was coded in Python. The code is also available for you. There's two versions, one in momentum, just straight momentum, one using relative strength with momentum, and there will be more screeners all utilizing Python. In applied analysis, I'm doing this one, the use of AI for financial analysis. And it matters what model you're using, the type of prompt that you give. I'll show you how you can get it done in GPT-4, in Gemini, in Claude, and in DeepSeek. And I'll show you some interesting output where the same prompt using the four different models will get you different things. So it is, I think, worth having more than one model to use. And just by changing prompts a little bit, you can get different output. So there is some work to do in learning how to ask a model, and depending on what model you're asking, learning how to ask it the right question. So we'll do financial analysis for a sub-industry. We'll do a whole industry. I started with coal. Because Trump has reintroduced clean, beautiful coal, or is it beautiful, clean coal? It's beautiful, clean coal. That is the executive order. You must use the words beautiful and clean before you use the word coal. So I started using it, and in about 20 minutes of just tweaking the prompt, I estimate I was able to save maybe about 6 hours of work, 7 hours of work that I would normally do to get the content that it delivered to me. Now, it's not perfect. You do have to go through it, and then at every so often you have to prompt it in specific areas again, and then you do have to check some things. But it does save a considerable amount of time. So we'll actually do a whole video on generating the sub-industry video, understanding coal mining, by using AI. So rather than me showing you a video on the coal industry, I will show you a video on AI outputting what we need to know about the coal industry. That's kind of cool, right? A competitive analysis. We can use it to generate a very fast competitive analysis of the top 5 companies by, let's say, revenue. By, let's say, revenue to China, by, let's say, the amount of metric tons mined, by market cap. However we want, we can do a competitive analysis. And then we will do a company analysis by feeding it a 10K and asking it to summarize it, and then feeding it certain parts of the 10K and asking it very particular questions. So we'll do a whole analysis from the sub-industry down to the competition, down to a company analysis. And a lot of the work is in the prompt, and the prompt is a function of the type of model that you're using, how the model is designed, so we're going to have to read some technical notes there, and the perspective from which you're asking the question from. So it usually takes me 3 weeks to do a really deep dive on a sub-industry, 3 to 4 weeks to really get to where I want to be. I'm going to take the 3 to 4 weeks and get right into this stuff, and then I'm going to show you how you can probably get all of this in about a couple of hours just by modifying your prompt. So taking like 3 weeks, and what would normally take me 3 weeks, bringing it down to a couple of hours. That is called power. And you better know that going forward. That will be in the applied analysis, and that will be a series of videos. I don't think I'm going to get that done in one video. That will be a series of videos because there's a whole bunch of front-end work that I'm going to have to do to explain the type of model and perspective so that we can work with some simple prompts first so I can show you what I mean by that, and then we'll go into something deeper. Okay, let's head in. We have a lot to get through this week. I've put a lot in here. The big story from last week was Powell versus Trump. I'm going to call it round 2. And if you're scoring this one, you got to give this one to Powell, maybe a 10-9 round. Look at the yields here from the 2-year to the 30-year, all recovered somewhat from the week before. Had a big move up in yields. They've come down a bit, but have not recovered as much as they lost. I think this is short-lived. I'll lay out my argument in the screens coming up, but I think that yields on the long end of the curve go much higher. We have the FOMC in 17 days. Almost 91% on no rate cut. And this is primarily based on what Powell said on Friday at the Economic Club of Chicago. I have a whole screen on some of the points that he made. In between now and then, you have a couple of items coming out. PCE, I don't think that's going to give much help. Not much more help than what we've seen from CPI already. We get the ECI, the Employment Cost Index for Q1. I don't see a lot of help there. When I say help, I mean help in getting Powell to cut rates. I don't see much help there. Q1 GDP and April jobs report. We will get that. You get Q1 GDP at the end of the month, and you get on 2 Fridays. Not this Friday coming up, but the next Friday you have a jobs report, April 2nd. What would help Powell cut is a negative print on Q1 GDP and a dismal jobs report. No jobs created or very few jobs or even jobs lost. That would be permission to cut. I personally think he has permission to cut right now. If it were me, I would be leaning more towards a cut. So I don't agree with the 90.9, but I think the market probably has it right. I just don't agree with that. I think he does have permission to cut now. Let's say Q1 GDP is negative. Everyone's going to be looking at the M component, the imports component, and I'll show you in a little while why that might be important. If you remove the imports component, the front running ahead of all the tariffs, if you remove that or adjust for that and you still have a positive Q1 GDP without that effect, I think that will be the dominant number to look at as opposed to the overall negative number if we do get a negative print, which means the jobs report would have to do all, well, I'm not going to call it heavy lifting at this point, all the really light lifting. In other words, show nothing to get the Fed to move. I don't think this Fed wants to help this president. Let's just say that. I don't think this Fed wants to help this president. And if they do cut rates in May, it's got to be really clear that they have permission from the data to cut. Otherwise, they're going to look like they're bowing to King Trump, and they're not going to want to do that. We have a flat curve from the 3-month to the 10-year. The money market to capital market curve is now flat again. It dropped 14 basis points. For the week ahead, what do we got? Canadian PPI in 2 days. Last week, Bank of Canada made no change, so I don't see this as being important, but there it is. It might affect the currency, but I don't think by much. Durable goods for the U.S. in 4 days. That'll be interesting to look at. I think once we start getting some of the April data in that has the effect of the tariffs, both the real effect for however long some have been in place and the psychological effect, the change in behavior because of it, it'll start to be reflected in April data going forward. 4 days. Consumer sentiment, University of Michigan, 5 days was dismal last week. Does it continue that? You have some Fed speak going on this week, but I think the main speaker, Powell, has spoken. I don't know how important this is to look at anymore. Reverse repo hit its lowest for this cycle, $54 billion August 16th, ended the week at $58 billion, heading towards zero. Reserves are down as well, but let's keep in mind that you had tax payments that were due. So a lot of money sitting in bank accounts were sitting there ready to pay their taxes, which means they transferred from their own personal or business accounts to the Treasury general account. So you would see reserves drop. for tax payments. Same with the reverse repo money coming out of money market funds to make your tax payments. So the TGA increasing, whereas the reserves in the system would decrease until the TGA starts spending that money and throwing that money back out into the banking system, which then shows up in reserves again. Let's see if that reverses out. TLT had a good week, as we pointed out up here. Up 0.97, SPX not so much, down 1.54, and I'm going to start adding the DXY in here. If your domestic market is the US, that's not important to you. If you're an international investor investing in the US, this is going to become more and more of an issue for you, because I do believe we are in a downward movement on the US dollar. And I think that continues on week over week, down 0.53. So even though TLT had a positive week, 0.97, the long end of the curve, U.S. Treasuries recovering somewhat. Depending on the currency you're holding, whether if it was the Canadian, the yen, or the euro, you actually showed a loss in your own domestic currency. And this is how you have to start thinking about it, unless you say, look, I'm going to be in the US for the next 10 years. I don't really care about the currency. There are more and more reasons why you may want to hedge out the currency. For most individual investors, the easiest way to hedge out the currency is just to get out of the asset. And I think at the margin, that is what is going on. And as that is going on, that puts more downward pressure on the US dollar and more upward pressure on other currencies as investors repatriate their dollars. So negative 0.53% if you're in Japan. That one I can clearly, I think I have clear appreciated by more than what TLT did. So you actually ended up with a loss. Now, if you're in US equities, you lost 1.4, broadly speaking. You could have been in just the few that went up. Maybe you had better allocation, but broadly speaking, if you're diversified across U.S. equities, down 1.5%. Add to that the loss of the U.S. dollar as well, you're down even more. So from an allocation perspective, from an international allocation perspective, the U.S. is looking less attractive, and you have to overcome the weight of the U.S. dollar, which I think probably has more downside to it. I spoke with one person last week who is close to allocation decisions for a large pension fund in Canada. I can't say much more than that without revealing probably who I'm talking to. They are beginning the process of underweighting U.S. assets and overweighting Canadian assets. Still with a large allocation to the U.S., but an underweighting, which means at the margin they have to be sellers, and at the margin they're buyers of Canadian assets. So at the margin they're sellers of U.S. dollars, at the margin they're buyers of Canadian dollars. So that is going to add, at the margin, again, some more pressure to the U.S. dollar. Effective federal funds rate of 4.33. Here is our Fed funds futures curve. Our implied rates, I've written down here based on where the index value is. Pretty much the same week over week in terms of the rate cuts implied by the Fed funds rate, but being pushed further into Q3 and Q4 coming out of Q2. Less than one cut, half a cut, let's say, because it's being priced out of May. 3.5 cuts in 6 sessions. If you get a recession, I guess it depends on the flavor of the recession and the type of recession and how the FOMC feels and the rhetoric from Trump. The worse it gets from Trump, the more likely I think he is to force the Fed into a position where they will only act if it's very clear that they should act, to avoid looking like they're bowing down or acquiescing to what one person wants. All in an effort to maintain the psychological belief for investors that the Fed is in fact independent. So Trump is not helping his cause here. He's not helping the cause at all by doing what he's doing, because if they do feel that they have some permission to move, it will now appear that they're less independent than they used to be, which is a bigger problem. So it's actually making the problem worse. That the best thing Trump can do at this point, I think, is stop harassing the Fed, but that's not his style. Following along with capital market yields being lower, real yields also are lower as well. Break-evens kind of flat. Looking at OAS, they also contracted as well, in line with the recovery in nominal yields. In 2020 to about 2022, you had very, very low rates. And during that period of time, as far as corporate issuance goes, it was really high because rates were so low. Most of the high-yield debt, and I'll just circle where we have high yield on here, most high-yield debt tends to be 9 years or less, the longest 9 years, in between 3 to 5 years, with 5 to 7 kind of being the preferred tenor. Let's say 2020 to 2022, puts those maturities 2025 to 2027, and a lot of debt was issued during that period of time. Refinancing that now is refinancing it at much higher rates. So that's sort of what might be keeping small cap stocks under pressure, is just the amount of refinancing that's going to have to be done at these higher rates. Looking at unemployment insurance for continuing claims, that is creeping up. People staying on unemployment longer, even though initial claims really aren't moving that much, down 9,000 week over week. If it's not seasonally adjusted, you are up about 3,000. But looking at initial claims filed in federal programs, 542 for the week ending, 508 the week before. These are not numbers that are suggesting that DOGE is making significant inroads at all. Now, if we think, well, they all got severance, we're really not going to see it for quite some time. We may never see it if during that period of time that they have severance, they're able to line up other jobs. They may bypass the unemployment lineup altogether. We may never see it, but we're certainly not seeing it at this point in time. Mortgages, 6.83, up 21 basis points Thursday over Thursday. The spread between the U.S. 10-year and the 30-year fixed rate, 249 basis points. Last week, we had D.R. Horton announce earnings, and it was a miss, a swing and a miss, and much lower guidance. Revenue for 2025, they're guiding to 33.3 to 34.8 billion. That's down from 36 billion to 37.5. So midway through here is, call it 36.75. Midway through here is about 34. So almost 10% down on revenues for their guidance. Their sales, 85 to 87,000 homes, making up this revenue, down from 90 to 92,000. And I'm going to show you some data from Realtor.com in a second. We're getting inventory builds in the U.S., particularly in some of the southern states, California, Texas, Arizona, Florida, Nevada, where D.R. Horton has a large presence. Days on the market are increasing. Price cuts are increasing, and it's March, usually going into the spring season. You don't get that many price cuts. You start getting them once you get into the summer, July, August, September. If they haven't sold in the busy season, the spring season, now's the time to cut. But you're getting huge amounts of price cuts going in to the spring season. Okay, this is weekly housing trends. Week of April 12th is the last column here. This is the week of April 5th. This is the week of March 29th. All the numbers in here are year over year. So we can see median listing prices year to date, negative 0.8%. New listings year to date up 8.1%. And if we look at what happened in the last 3 weeks, as of the 29th, year over year was up 31.2. For April 5th, year over year was 8.6. Week of April 12th, up 12.8. These are all higher than the year to date, implying that the year to date is being pulled upwards by the more recent weeks. You can really see it with active listings up 27.6% year over year, with a lot of the more recent weeks pulling it higher. Week ending March 29th, active listings up 32%, 30% for April 5th, and 31.2 for April 12th. Time on the market, 5 days slower, meaning it's taking 5 days longer on average than it did the year before. And you can see that that has slowly been increasing, 2 days slower, 4 days, and then week ending April 12th, 4 days longer. Let us look at March. For the full month, because we do have that data. This is active listing count. Here we are here. You can see it moving upwards here for March. Usually it would increase a little bit into the beginning of the year. It tends to fall into the spring season and then increase after that. You can see that trend down here. These years down here, the yellow line 2022, the green line is 2021, the pink line 2023, there's 2024, and this line here is 2020. There we are. These are all pre-pandemic up here. 2017, 2018 is the orange, and 2019 is the red, and we are moving up, and we'll see how that plays out over time. Here it is again, March 25th. March 2025. Total listing count. We can see it's above the post-pandemic years, but not above the pre-pandemic years yet. This is newly listed homes. You can't see it right here, but it's hidden right in the yellow line here, which is 2022. Newly listed homes, you can see that really starting to increase. It's starting to increase, but it's sort of in line with pre-pandemic rates of increase, but certainly not post-pandemic. Where housing inventory is growing the fastest. In the West, 40%, the South, 31%, Midwest, 17.7%, the Northeast, 11.3%. At the metro level, all 50 of the largest markets saw inventory rise year over year. Some of the biggest gains: San Jose, California, Las Vegas, Nevada, Denver, Colorado, all in the 60%. Most metros still have fewer homes available than they did pre-pandemic. That said, 18 markets have now surpassed their 2017-2019 inventory levels, up from just 15 last month. 18 now. Meaning the rest of the 50 largest, you still have 32 that are lower than pre-pandemic, but now we're up to 18. Denver, San Antonio, and Dallas. Home sellers return, boosting new listings in most metro areas. Inventory of newly listed homes increased across all 4 regions, led by West, 14%, South 10%, Midwest, and Northeast. Biggest year-over-year gains in new listings: Denver, San Jose, Richmond. We've seen those up above. Home listings linger slightly longer than last year. There is March over here. Everything below is post-pandemic. The green is 2021. The yellow is 2022. The pink is 2023. The brown is 2024. Notice that it is above all of those, but still below pre-pandemic levels. And then it gives you time on market rose in all 4 regions compared to last year. In every region, homes are selling faster than they did pre-pandemic compared to the 2017-19 average. We can see that they are still moving faster. Northeast, 19 days faster, but we've seen from above when we looked at the Northeast, it tended to have the lowest level of newer listings. And up here, inventory is growing, but growing the slowest, 11.3 versus all the others. So it would stand to reason that if we are seeing time on market, it would be from the Northeast. Sellers are cutting more often. So where are we here? Right up here, the median price for March is sitting up here. This is in line with 2023 and 2024. So median prices have increased quite a bit. This is price reductions. Look where it is. The percentage on price reduction, 17.5, above all the other years. So it's above post-pandemic and above pre-pandemic. And again, for this time of year, look at the trends. It's usually downwards. This has been straight up. It's usually odd to see that type of price cutting going into the busy season, which is the spring buying season. That is the busy season, up 17.5 above all the years. And this is where the regional metro area price trends year-over-year, median list price changes by region. Midwest and South are both down. West is flat. Only the Northeast is up. So I'll leave that the links to these two in the description box below, so you can go through it. So to sum up from that from the last screen, I don't know that I would be too eager to get into U.S. home builders at this point. Probably not for a couple of quarters. Let's see how it plays out, where the 10-year goes from here. I got a sneaking suspicion the 10-year goes higher. I also have a sneaking suspicion inventory probably continues to climb, which isn't going to help home builders too much. Let's move over to SPX. SPX drifted down last week. For the last couple of weeks, I've said that I would short every rally. I believe the words I used was with impunity. I have been doing that. That has been working out well. I still net long U.S. assets. If we split it between equities and treasuries, I got a big position in duration, which you know I've talked about that for quite some time. I am looking at paring that down, and I do have a position in U.S. equities, which I have been reducing over time. As the market gives me opportunities, I sell on green days. I no longer buy on red days. I used to do that. You sell on green days, you buy on red days. I see red days. I'm not adding to my U.S. positions. I'm adding to my Canadian position. So I am decreasing my exposure to the U.S. If we look at the four-quarter operating earnings, the forward four-quarter, 275.24, down from 277.32. That is a fairly big drop week over week. I don't recall if I've seen it drop that much. Usually when it drops like 45 cents, 70 cents, something like that. That is over a $2 drop in a week. Also, we do have a move from international allocators from being overweight U.S. to moving towards being more equal weight or underweight. The combination of dropping earnings and a move away from an overweight position is going to drop the multiple. So I have two scenarios here. Earnings end at 260 with an 18 or down to 250 at a 17. The longer this fight goes on with China, the more likely you are to end at about 250 in terms of the four-quarter forward operating earnings, right? And a multiple of 18 versus 17, so 260 at 18, I get to 46.80, 250 at 17, 42.50. So within that range, I would probably say, okay, that you probably find a good entry point for U.S. equities within that range. We're sitting at 52.80 on the index, getting down to 46.80 is another 600 points down, a little over 10% down, getting down to 42.50. You got another 400 points from there, so that's about another 1,000 points off the index where it is, almost 20% down from where it is. And really, this is dependent on how long the administration stays on this particular course, how long China decides that it does not need the U.S. as much as the U.S. says it does, who's going to make the first move, how they're going to engineer a victory for both sides, because you have to. The longer that goes on, the more likely you're going to get 250, the more likely you're going to get a move not only from overweight U.S. equities to equal weight, but maybe even underweight. So you could get down to the 17. So I seem to think that somewhere in that range, call it 4,500, seems to be where I would probably say, okay, well, now I don't mind having more assets in the U.S. or more exposure to U.S. assets. And that is as long as this whole talk about taxing capital, foreign capital, goes away. You have, I guess, some conversation about withholding tax for non-U.S. residents as high as 50%. I sent that link into my money manager at JP Morgan saying, if this happens, I see no reason to be in U.S. assets any longer. If you're going to do a 50% withholding, that's 50% withholding on your interest payments, 50% withholding on the dividend payments. And there is some talk about canceling the tax treaty between Canada and the U.S. So all the U.S. Stocks that are held in retirement accounts, right now there is no withholding because of that tax treaty. If that goes away, suddenly you're facing anywhere from 35 to 50% withholding tax. There's going to be a lot of selling of U.S. assets to avoid that. You got to stop that conversation from happening. Now, I don't think that's going to happen. I think that's just a wild shot. The last thing you want to do is start chasing away the very capital that gives your market the valuation it does. If they are going to pursue that, get rid of that 17, bring it down to 15, maybe even 14 on the multiple, because if you don't have international allocation support for your market, it doesn't justify a multiple at that level. Only justifies that multiple if you think, well, the market's going to outperform, and if it's going to outperform, I want to be in it. So obviously, outperformance means a higher multiple for every dollar of earnings. That's what that means. So that conversation has to go away. But that caught my eye the moment I saw it. Is if you're going to start taxing the income at that level, there is not enough capacity in zero coupon bonds to move from zero coupon bonds, and the majority of investment money is held by boomers who are in or near retirement, who are not holding on to zero dividend paying growth stocks. They're in income paying value stocks. They would flee from that very quickly. That has to go away. Sitting at 19 times forward earnings, 19.18, down from 19.34. The drop in the SPX helped lower the multiple, along with the drop in earnings as well. Implied volatility still elevated, but coming down a bit. Same with TLT, elevated, but just coming down a bit week over week. If we look where our last reading was, SPX 25.6%. At one point, we were under 10% within the last year, under 10%, 25.6 down from 31.5, and TLT 17.7 down from 24%. Other indexes not doing as well as SPX. SPX is down 14% off its all-time high, which was February 19th, 2 months ago. We're April 20th now. 2 months ago, down 14%, having actually touched a bear market on a closing basis. We were in a bear market for 12 hours. from the close of the market to the open of the market. What was that? 4 to 9:30, 19 and a half hours. We were in a bear market. And then up we go the very next day. Let's take a 90-day pause on all of this, because the bond market is getting, as Trump said, that very technical term, yippy. The bond market's getting a little yippy. So off we go, but then we're sort of fading away from there. IWM, IJR, small caps, the Russell versus the S&P, down 23% on the Russell, down 24% on S&P small caps, and triple Q down almost 18%, with a SPY only being down 14%. And I think you probably have more downside on all of these if you are re-rating this multiple. They're all going to head down. So I am rethinking my positions. As I said, in U.S. equities, I short the market on any rally. I mean, could you get a big rally in the market if Trump says, hey, listen, I talked with China, things look good, here's what we're going to do? You probably get a big rally, but let's remember, you still have those 10% tariffs across the board. And you have reciprocal tariffs coming back in 90 days. And you have a boycotting of American products and a potential $90 billion hit to tourism for 2025, based on some estimates that I've seen, is that the hit to tourism for the U.S. will be around $90 billion. I'm going to show you some numbers in a little while, showing you just the fall off week over week in terms of imports to the U.S. and exports from the U.S., just the big fall off. But with a grain of salt, it was a run-up ahead of the tariffs, so the week after was okay. First week of April versus last week of March, we would see a big change. But with all of this going on, I seem to think that where we are in terms of earnings, where we are in terms of the multiple, and therefore the index level, we still haven't reflected, I think, where we're headed. 450 to 480 on SPY, I think, represents probably a market that is more fairly valued and at a multiple that would represent an either equal or underweighting of U.S. assets. For earnings coming up, I don't expect them to agree. That's just too much of a big number. If there were like two companies, yeah, I would expect that they would agree. I mean, you can't mess up that badly. But that's this is where we are, right? If you can't get the small stuff right, how do you expect me to have faith that you're getting the big stuff right? I'm going to show you that with CNN shortly. I'll show you a couple of I got one really neat picture from Barcelona, because that's where I am now. I was walking down the streets and I said, what is going on over there? And somebody explained it to me. I thought, no way. I had to take a picture of it. I'll show you what that looks like. And then later that evening, I'm watching CNN on YouTube, one clip, and I noticed they had written something down. I thought, oh, come on. You're CNN, for God's sake. Journalism. You can't even get this right? Again, you can't get the small stuff right. How can I trust the big stuff? Let's go through here and see who's reporting this week. All right, here's our distribution. Not much on Monday, only one. We start on Tuesday. So Verizon, whenever we see Verizon, AT&T, and T-Mobile are usually not that far behind. We have some financials in here. Industrials will become interesting because they're probably tied more globally than most. So some of the guidance here will be interesting to see. Tesla and Pulte, which is a home builder. Tesla, I am short Tesla, only 400 shares, but Tesla, you can't be short that many shares because it is still a cult stock. But I'm going to stay short through earnings. They have not done well. I could walk away now with a profit, a fairly good one, but I'm going to stay short through earnings. I don't see how they make earnings. If they do make earnings, I am going to cry foul. I'll take a lesson from the president and say, oh, they're lying. I cry foul. I'm being cheated. It's being stolen from me. Newmont. Gold prices have been on an absolute tear. If we anticipate a lower US dollar going forward, which I do, and a desire to be away from US assets, U.S. Treasuries, we're going to need another alternative as a safe asset. Where's that going to be? At the margin, gold will get some of that. So their guidance will be interesting. There's AT&T. T-Mobile is probably just a day or two behind that. Some financials that week, and then more industrials throughout here. Boeing will be interesting because China has singled out Boeing as a company to avoid. Cancel whatever orders you have, return some planes. Sorry, but we don't want your business anymore. So let's see what Boeing has to say as far as their guidance is concerned. There's IBM in there. We don't have too much tech this week. Well, I shouldn't say too much tech. Too much of the big names that we'd normally pay attention to. There's IBM in there. NextEra in energy. You have First Energy and NextEra. NextEra telling a different story than Duke, and they both share Florida. Duke Energy having hit 52-week highs a few times in the first quarter. NextEra, nope, nowhere even near there, going in the opposite direction. Can they pull it out? Can they give us some reason to keep holding on to their stock, because it just has not been performing very well. Let's go to Thursday. Freeport. Copper prices have been strong. Gold prices have been strong. When we think of their Indonesian operations, you think of gold. With gold prices this strong, that copper is basically free. They're profitable just with the gold even before they start selling the copper. However, you do have talk about imports, tariffing copper imports into the U.S. and with the U.S. and China in this stupid war, that is going to weigh on copper demand. Let's see what happens in their guidance. It hasn't shown up in pricing yet. Let's see, anything else jump out at us? Southwest Airlines, Texas Instrument, Service Now. They've been a high rider. In consumer staples, Pepsi, Procter & Gamble. Let's see, anything else I want to... Oh, Amazon. Amazon on Thursday after the close. And we got 16 on Friday before the open. T-Mobile, there's T-Mobile. I was wondering where that was going to end up. Intel. And there we go. I mean, there's a bunch more here, of course, but not sort of the headline ones that we look at. All right, let's get right to the cage match. Powell versus Trump. April 16th, Powell was speaking at the Economic Club of Chicago and then was interviewed. Some of the questions focused on the effect of trade. Tell us about the Fed put. Have you seen long rates lately? What have you been doing with reserves, dollar supply, U.S. federal debt? So on effective trade, this probably upset Trump quite a bit. We'll be seeing higher inflation and lower employment as a result of this. So we will be moving away from our goals for the balance of the year. That is not the message Trump wanted out there, that everything he's doing is going to be lower inflation and more jobs. And here's Powell saying, no, it's going to be the other way around. The tariff announcements that were made April 2nd were larger than anticipated, so the economic impact will likely be larger as well. Now, these were delayed for 90 days. The question is, Are they even going to see the light of day again, or can we say, well, look, those simply just won't happen? Will he declare victory in 90 days, which will be early July sometime? Come out and say, well, all these countries came and they bowed down and gave me everything I wanted, so we're going to let them off the hook. We're not going to worry about reciprocal tariffs. I don't know. Big question mark there on what he wants to do, or what he's. I don't even think he knows what he's going to do until the day that he does it. Fed put. He laughed and said, "No, there's no Fed put." Let me explain why. Markets are functioning as one would expect. The markets are selling off. To paraphrase him, he says, "Well, duh. What do you think is going to happen? This is not a reason for us to step in. This is not an unorderly market. It is doing what it's doing. We're not here to protect the value of assets from normal changes in fundamentals. So we're not going to do anything." That's not helpful for markets. Rising long rates, again, he pointed, markets are orderly. Yeah, they're doing what they're doing. Markets are orderly. They're acting as expected given the uncertainty. And he said there may have been some private sector deleveraging that caused the initial rise in yields. For reserves, he said they are abundant, and the debt ceiling was the main cause of the slowdown in runoff. Because if you hit the debt ceiling, then you lose, what he says, you lose visibility on some of the information that we need to determine where the level of reserves would be. So it just was prudent to slow the pace of runoff ahead of this thing, but it had nothing to do with anything else. He was trying to be very clear on that we are not being political in one little bit whatsoever. We're not going to bow to anyone's ideology. We're going to follow our own path. Dollar supply. U.S. swap lines will stay open. They have swap lines with 5 of the major central banks, and he says they're always there. There shouldn't be a problem with that. U.S. federal debt. Here, he had some harsh words, and I think waded in to a critique of fiscal policy somewhat, which for him was, kind of slapping Trump in the face, saying, "Hey, buddy, wake up," or tantamount to that. We are on an unsustainable path, but it's not an unsustainable level. Okay, he said that before. He said that under Biden. He started, saying, listen, the U.S. debt is on an unsustainable path. I think we can all look at that and agree. No one's going to fault him for that. As far as the level, he says, we are uncertain as to how high it can go, but it is an unsustainable path right now, although it's not an unsustainable level. And then he said, Medicare, Medicaid, and interest payments, that's where the problem is. And none of these are a Fed issue. The interest payments is related to the amount of debt that's issued, which is a fiscal and Treasury issue. The Fed has no control over how much debt is issued, nor do they control Medicare or Medicaid. Domestic discretionary spending. This is not a problem or an issue. It has already been decreasing. The issues are in here. Wow. For the Fed chair to start pointing to specific budget line items and saying, there's your problem, right in there. Medicare, Medicaid, your interest payments, your debt is on an unsustainable path. This is being as clear as you possibly can. There is no Fed put. The effect of trade is going to be negative on both inflation and employment. As far as rising long rates, don't look for us to do anything there either. Markets are functioning as normal. This is putting all the blame on the fiscal. How do you think Trump responded? So this is what Trump posted on Truth Social. ECB is expected to cut interest rates for the 7th time, and yet, too late, Jerome Powell. He's already given Powell a name now, the too late name. Once you get a name, that's the beginning of the harassment, right? Now he's got a name, he's going to use that name a lot. Too late, Jerome Powell of the Fed, who is always too late and wrong, all in capital letters. Too late and wrong. Yesterday issued a report, which was another and typical complete mess. Everything other people do is just a complete mess. Oil prices are down, groceries, even eggs are down, and the USA is getting rich on tariffs. Too late, should have lowered interest rates like the ECB long ago, but he should certainly lower them now. Powell's termination cannot come fast enough. Termination cannot come fast enough. Not the end of his term, but his termination. He can be removed for cause, but let's keep in mind here, cause is going to be whatever he wants it to be. If you put a couple of people on the task and say, go find me cause, if your job is to find cause, you will find cause. Even if your cause is that he is a saboteur of your master plan, Mr. President. He is actively working against you. That is treasonous. That will be cause. I am of the thinking that he is more likely than not to find cause, that he will probably go down that path. You cannot fire the Fed chair. Oh yeah, says Trump, who never likes to be told what to do. And if you tell him that you cannot do this and nobody can do this, he will do that just to show that he can do it where nobody else can do it. The more you say he can't do it, the more likely he is to do it. Removal for cause, he'll find cause. This is just a headwind. Just this fight going on is a headwind for treasuries and by extension the US dollar, which are already under pressure because it is a direct challenge to the independence of the Fed. And if he follows through with an appointment to the Fed in line of the appointments he made, where those people are loyal to Trump first and foremost before they're loyal to anything else. The Constitution is a distant second. Loyalty to the king. If he has somebody or the market believes that his appointment to the Fed is going to follow suit, the independence of the Fed will get questioned. And that will be really negative for treasuries, really negative for the US dollar. In fact, the person, I guess, that is the front runner for this one has urged the president to not remove Powell, specifically because of that. It would just make his job that much more difficult. Do not remove him. But Powell's termination cannot come fast enough. This is the beginning. You know what's going to happen from here on in is the name calling is going to grow, the harassment is going to grow, the pressure is going to grow. I wonder if on Polymarket there is a bet for when the first death threat on Powell will occur from somebody out there who feels Powell is being treasonous, because that is what it incites. I would not be surprised to hear that Powell will have to have extra security. Let's have a look at this little chart I drew at the bottom, this little graph that I drew, because this is going to be an important setup to the conversation on the next screen. In white is our yield curve, and I've divided it in between money market rates and capital market rates. The overnight rate, the Fed funds rate, is 4.33%. Money market rates will be a reflection of the overnight rate. So if you lower the overnight rate, money market rates should rise and fall with the rise and fall of the federal funds rate. The capital market curve is set by the market, forces of supply and demand in the market. So the white line, let's just take that as the standard yield curve. And what we've seen over the last little while are equity prices dropping. If U.S. Treasuries are acting as a safe haven and the U.S. dollar is acting as a safe haven, what we should have seen is a bull flattener. This is evidence of safe haven status as the market value of equities drops. In other words, we're saying the correlation between equities and sovereign bonds is less than 0. This is why we hold them in a portfolio, is because they act as insurance. That if our equity prices start to fall, we're not going to see our portfolio values fall, because we'll have bonds that then rise in value and protect the overall value of our portfolio. We could be 100% equities, but then would have to pay money to buy puts to get that kind of insurance. This is the kind of insurance that a safe haven asset offers us, and because it offers us that benefit, we're willing to pay a little bit more than we normally would for that asset, which means we tend to get lower yields on it, specifically because it performs that function. Well, what if it doesn't perform that function? Are we willing to buy it at lower yields if it doesn't perform that function? At that point, we would say if it's not a safe haven asset, it's just yet another risky asset. Maybe not as risky as equities, but it's no longer a safe asset. It's a risky asset. I'm going to need a higher yield for that. Well, this is what we've had. As equities have come down, we've had a bear steepener, implying that the correlation between equities and sovereign bonds is greater than 0. If it's greater than 0, it doesn't offer us any insurance value, any protection value. There may be some diversification value if it's correlated less than 1. But beyond that, it's yet just another risky asset in our portfolio. If it's not going to provide a protection feature, but only a diversification feature, maybe we don't need an allocation as big to it. So unless it starts acting like a safe haven, it will be allocated to as if it were a riskier asset and not a safe asset. The bigger challenge comes from the foreign holders of U.S. Treasuries. If you're a domestic holder holding U.S. Treasuries, at some point in the future, you get your money back. All you have to worry about at any point in time is if you want to sell it. So you're only concerned with, does the price of the Treasury go down or the price of the Treasury go up? I can always hold it to maturity. The foreign investor can do the same thing, but has U.S. dollar exposure tied up into it. So they have to start thinking of, okay, sure, I can hold it for the next few years to maturity or the next 5 or 6 years, but where is the value of the currency going to be at that point in time? I could take a significant loss because of it if they're pursuing policies that suggest that less capital is going to flow to the U.S., that fewer investors are going to invest in U.S. assets, that there'll be a global movement away from overweighting U.S. assets to equal weighting or underweighting. I must worry about the currency. Institutional investors can always hedge out the value of the currency, but smaller investors couldn't. So at the margin, there would be pressure on the U.S. dollar. So because foreign investors investing in U.S. assets are really buying a structured product, they have to think about both legs. To give you an idea, let's say, and I'm just going to make up some numbers here, that you're in country ABC. That could be whatever country you want it to be. And the exchange rate between ABC and USD is 140. Let's say that you can, that $1.40 USD or 140 of your currency gets you 1 USD. Let's go that way. 140 of your currency gets you 1 USD. And let's say that the US dollar depreciates over time, so that you had 1,000 US dollars, which is 1,400 of your own currency, and the US dollar is going to depreciate. But the value of the asset's going to stay the same. Let's just leave it at that for now. No appreciation or depreciation. But let's say instead of 1,000 buying 1,400, it now only buys 1,200. Because the exchange rate is now 120 instead of 140, you've lost $200, even though the value of the asset hasn't changed, because you do have exposure to the other investment, which is the US dollar. You're long an asset and you're long the US dollar at the same time because the asset is denominated in US dollars. You can always separate that by saying, well, I'll hedge out the value of the currency, thereby only being long the asset. For individual investors, that's not really a viable option. Even for international investors, hedging out the value of equity is difficult to do because what value do you hedge? The value today, the value tomorrow? What if the value of equities drop 10%? Now you're overhedged. You're actually now making an active bet on the currency, which you didn't want to do. So it's not that simple. It's easier sometimes to say, well, let's just not overweight. Let's equal weight or even underweight. I explained this before. This is the current account and the capital account. The current account and capital account must be equal. So if you have a negative current account, you have a positive capital account. In other words, a trade deficit is financed with selling foreigners' assets. When you sell foreigners' assets, in other words, you're just saying, hey, listen, we got to come up with some extra money because we're spending more than we make. Where can we borrow money from? I know, we'll borrow money from foreigners. We'll sell them bonds. Which means foreigners own those bonds, so you'd have a positive capital account balance. Now, foreigners are only going to buy those bonds if they're willing. They don't have to, only if they're willing. And if you do not have safe haven status like this, they're certainly not willing to buy it at safe haven prices, which means yields are going to have to be higher to induce them to actually lend you money. Think about it as a household. You earn $1,000, but you want to spend $1,200. That's fine. Where are you going to get the other $200 from? You say, well, I'll pay you 7% interest. Everyone says, no, I'll pay you 9%. Nah, not 9%. You're still not worth it. I'll pay you 11%. Somebody may say, well, okay, 11%, I'll lend you $200. Here you go. Now you can spend more than you make. You need someone to lend you the money. In macro terms, that comes from issuing debt. Whether corporations issue the debt or whether governments issue the debt, somebody has to issue the debt so that they can get the money so that in the aggregate, the country can spend more than it makes. So if you're going to continue to run a trade deficit, you have to continue to sell your debt. Foreigners must be willing to hold your debt. And if you don't have this extra little benefit that, you know what, holding that debt has this value for us, then you're not going to be priced at that. On the screen, I have two charts. The upper one is U.S. trade deficit since 1992. And the bottom one is the fiscal deficit since 1992, 96, 94, 92. I do have it set up for 1992 so that it sort of mirrors this. This is monthly, this is yearly. Let's point out a few things. Let's go to the late 90s. You had fiscal surplus. And then if we draw a line of best fit, I'm just going to eyeball this sort of downward sloping for the next roughly 25 years. And if we go to the late 90s and do the same thing for the trade deficit, off it goes. It sort of makes sense. It has to make sense. Look at 2010, almost 10% the federal deficit as a percentage of GDP. If we go, here's the recession here. You can see the increase in the trade deficit. Look at 2020. It was 14.7% of GDP. And you can see the effect it had on the fiscal or the trade deficit. And it has to. GDP equals GDI. What you make is what you earn. Income equals output. If you want to spend more than you make, you have to sell your assets that you own. In other words, you have to tap into your stock of savings, or you have to borrow that money from somewhere if you're going to spend more than you earn. While you have a government 2020 spending 14.7% of GDP, it's got to come from somewhere. So it's either got to come from your own citizens. Your own citizens have savings, but they do have investments as well. So whatever's left over from savings minus investments must fund the fiscal deficit, or you have to borrow from foreigners. Either way, you're still going to have to import the stuff because you don't make it. You don't make it, so you're going to have to import it, but you can sell off your current assets to finance the deficit, or you can borrow from foreigners. Foreigners are willing to lend it to you, especially to the U.S., because the U.S. dollar and U.S. Treasury have safe haven status, When things in the world go bad, the US dollar gains value and US treasuries gain value. And foreign holders say, that is a good thing because it has value right when we need it. When our assets drop in value, these things save us. So we are willing to lend the money to the US at a low rate because it has this feature. That is what is being called exorbitant privilege, is the US's ability to sell its debt around the world for a price lower than it normally would simply because it acted this way in tough situations. It has safe haven status. If it doesn't, well, then the willingness of foreigners to lend the U.S. money drops at a particular yield. The yield would have to be much higher. Post-2020, look at the trade deficit here. Look how bad that got. But look at what the fiscal deficit was each year. 2020, 14.7, 12.1, negative 5.3, negative 6.28. That ends just at 2023. I have been critical of this for some time, suggesting that if you went back, and even on one of the market outlooks I showed you how to do it, if you went back and you adjusted adjusted GDP for a balanced budget, that if there was no fiscal deficit and you balanced the budget, what would GDP growth have been? Would have been much lower. Which means when we think about the value of U.S. assets at lower levels of growth, they would have been lower. So this brings us to the term U.S. exceptionalism. Exceptionalism meaning the outperformance of the U.S. versus any other market. That outperformance was mostly financed by government deficits that were financed through exorbitant privilege at very low rates. If exorbitant privilege is going away, if safe haven status is going away, or at least at the margin is being questioned, then U.S. exceptionalism at the margin is going to be questioned. You're moving from overweight to equal weight to maybe underweight these assets, as I explained, or as I laid out earlier when we looked at S&P 500. I'm going to spend some time on this screen getting you to my conclusion, which is U.S. Treasury yields, I think, continue to go higher. U.S. Treasury prices would then continue to go lower as a result, and the U.S. dollar also goes lower. As a result, the risk premium, the U.S. risk premium would have to increase. So equity prices would have to come down for the same dollar of earnings. If you expect earnings to be a certain number and not change, equity prices would still have to drop because of the higher risk premium. If you think equity earnings are going to drop along with a higher risk premium, then prices would have to drop even faster. That's sort of where I am. If the Democrats would have won, somebody did ask me this, well, what if Harris would have won? What would you have done? I would have sold treasuries right away. The hope in holding on to treasuries after Trump won was that he was going to get that fiscal deficit to zero, that Doge was going to show some good results, and you were going to stop this deficit spending. That would have been bullish for U.S. treasuries. Had the Democrats won, I don't think that they would have put that much emphasis on it. I would have decided at that point that let's get out of U.S. treasuries. But the U.S. dollar, well, that would have been a wild card. I probably would say, well, stay in U.S. equities, but get out of U.S. treasuries. The U.S. dollar is the wild card. Right now, I think get out of anything U.S. denominated until we see about mid-4,000s on equities, until we get the repricing to price out exorbitant privilege and to price out U.S. exceptionalism. To get you to this conclusion, I'm going to first introduce a framework in which to think about the people in charge. And for this, we're going to need a 2x2 matrix. On one side, we have a knowledgeable person. On the other side, we have an intelligent person. These are not always the same people. So let's just do a 2x2 matrix. And we will do it this way: low, high, so that we can have the cells line up nicely. When you have somebody low in intelligence and low in knowledge, you have a big problem. The academic literature has a name for this. It's called the Dunning-Kruger effect. Because what you have is somebody, borrowing the title of their paper, who is incompetent and unaware of it. Low level of intelligence is the incompetence part. Low level of knowledge is they're unaware of it because they don't know enough to know that they don't know anything. So they suffer a double loss because they don't have the skill set for something, but they believe they do. They're unaware that they don't know it. At the other end of the spectrum, you have somebody who is high in knowledge and high in intelligence. This is what we would expect from the people that we have in charge, is that they are both intelligent and knowledgeable. But even here, there is a name for people in here, and it's called imposter syndrome. Imposter syndrome because they are intelligent enough to be able to reflect upon themselves, and they are knowledgeable enough to know that they don't know everything. And because of that, they tend to have this syndrome called imposter syndrome, where they think that I'm not qualified for this, I'm not good enough for this, but they are. This is who we want in charge of things: intelligent people who are knowledgeable. Now, you also have this other cell over here, where you have knowledgeable people who are not intelligent, where you can say, here is fact A and here is fact B. An intelligent person would say, well, if A is true and B is true, C must be true. Whereas an unintelligent, knowledgeable person would say, well, I know A and I know B, but how are you getting C? You'd have to tell them C, and they'd say, oh, okay, I know that now. But they couldn't figure it out on their own. In other words, you would have to tell them these things. I'm sure we've all met people like this who they know a lot of stuff, but for some reason they just can't put two and two together. Even when confronted with stuff, you still must get the red crayon out and draw them a picture of everything. So you do have knowledgeable people who are unintelligent. Is this administration, when we're talking about the Stephen Mirrens, the Peter Navarros, the Donald Trumps, are they knowledgeable people who are unintelligent? Or are they knowledgeable people who are intelligent? There's no questioning that Navarro is a knowledgeable person. He knows stuff, but is he intelligent? Same with Stephen Mirren. He knows stuff, but is he intelligent? Right? Let's go through this, and depending on where they end up, you may change your mind on what you conclude, or if you conclude what I conclude. My conclusion, just to give it all away, is that they're over here. We have some very knowledgeable, unintelligent people who really don't know how to execute on the knowledge that they have, nor do they know how to determine whether or not the outcome of what they want to do will be positive or negative. They can't induct or deduct given certain circumstances. They lack the intelligence to see it. I think that we're here, which leads me to this conclusion. So let's go through some of this. What we are seeing, or what we're observing, is an attempt to achieve balanced trade bilaterally, having all these deals with these countries saying, we have a trade surplus with you, you got to buy more from us, as opposed to thinking about it multilaterally and saying we want balanced trade across all the countries, meaning that we are going to run a trade deficit with this country over here because all they have are avocados, and they don't have enough money to buy anything we have, and, well, we need the avocado, so we'll let that go. They don't see it that way, that if we're buying the avocados from you, we're clearly giving you money. Why don't you take that money we give you and buy stuff from us? So this is what they're trying to reach. that the current account equals the capital account equals 0 for each and every country, it stands to reason that the sum of it must also equal 0 as well. Now, this way here, US dollars do not build up abroad, so there'd be no demand for US dollars or US treasuries. However, there'd be lower issuance of US treasuries because if you're running a balanced trade, you don't have to issue any debt to finance it. So there'd be fewer capital securities that would have to be sold to foreigners, thereby preserving the price and the yield on the existing capital securities, because you don't have to then find somebody else to buy it because you're not issuing it. That means you'd end up over here. X minus M equals 0. And I've already introduced this identity over here. So if you're still going to run a fiscal deficit, net savings must finance that fiscal deficit. And you get that through lower consumption. So you have a U.S. consumer that makes up a large part of GDP by consuming. You have to say, listen, you got to get that a little bit lower. How do you get or induce someone to spend less? You give them higher yields. You make it expensive for them not to save. You can say, well, you can spend the money, or you can lend the government some money to finance their fiscal deficit, and they'll pay you 8%, 9%, 10%. At that point, you say, that's kind of enticing, right? It induces savings. And if you are going to get a yield curve that starts doing this, and car loans are priced off the 5-year, mortgages are priced off the 10-year, it discourages borrowing. Because to induce me to lend you money as opposed to spend it, you have to offer me a higher 10-year yield. Let's say you make it 6%. Well, then mortgages are going to be 8.5% to 9%. Well, there's where you reduce the amount of spending, or at least the amount of investment that individuals make with their savings, because a house is an investment. If I have savings, I can either put the money into a home, buy stock, buy bonds. If you want me to cut back on my spending and buy even more bonds because you're not borrowing it from foreigners, well, then you got to give me a higher rate. You give me a higher rate, everybody gets a higher borrowing cost. So it discourages borrowing and induces savings. However, it's going to make the fiscal deficit worse. Why? Because your interest payments are going to have to go up. So if this is the result we end in, you have to get out of U.S. Treasuries. That's where I get to there. Well, what if it's the other way around? What if you want to keep the level of consumption where it is and keep the level of investment where it is, saying, no, we don't want lower consumption. We just want more domestic consumption by getting more domestic production. What we want to do is not run a fiscal deficit, but run a fiscal surplus. And the fiscal surplus will fund consumption and investment. Because again, this side equals 0, and if you have a plus over here, you must have a minus over here. Keep the spending going, keep the investment going. We'll do the heavy lifting on this side. How do you get there? Well, it's T minus G. Lower the G, which is government spending. Well, that's what they've been trying to do with Doge, although early results are showing, that's not really going to happen. Well, the other side is higher taxes. But you ran on lower taxes. You ran on the idea that you were going to extend those tax cuts. No tax for Social Security, no tax for tips, no tax for overtime. You get no tax and you get no tax. For a while, he was handing out tax cuts like Oprah. Well, higher taxes come two ways. You can either raise tax rates or raise tax revenue. You can raise tax revenue by making the tax base much, much bigger. By doing that, you say, okay, well, we have 170 million people in the workforce. Let's get 190 million. Get another 20 million working. Let's create jobs for another 20 million. And without raising tax rates, you'll raise tax revenue because you have more people paying the same tax rate on their income. If you raise tax rates, you can do that with tariffs. But you said you weren't going to raise tax rates. And if we think that they are knowledgeable and intelligent, they would know that. They would know that a tariff is a tax on their own people. So They can do what politicians have done since the dawn of time. They can lie. They can lie to the people and say, it's not a tax. We're going to make other countries pay. Other countries pay the tariff, not you guys. You can just lie about it, but still, it is a tax on the American consumer. So you're going to get lower personal consumption out of that and lower aggregate consumption, unless, of course, you can raise revenue by raising growth by saying, why don't you just build in the U.S.? If you move your factories to the U.S., there will be no tariffs. If you build it in the U.S., you can get higher aggregate consumption because you get more people that consume less than they otherwise would had there been no tariffs. So you can just lie to them. Here's the problem with lying is you have to do it in secret. If I'm trying to tell you that you can't trust our group of friends, if we're in a group of friends of 5 and I pull you aside and I say, listen, you can't trust those other 3 people. I have to do that quietly. I cannot announce it in the room full of people. Why? Because now I've made enemies of those 3 friends. If you're going to lie to your own people and say the other side pays the tariffs, they're cheating us, they're ripping us off, they're stealing from us, we're going to make them pay, you got to do it quietly so the other people don't hear you. Well, everyone heard you. So now you have all of this pushback. An intelligent person would have seen that. And for that reason, I cannot conclude that they are knowledgeable and intelligent. They are knowledgeable and unintelligent. And because of that, they're not going to know the full effect of the actions they take. They're not going to know how damaging can be. They're not going to know when to stop until the house is on fire. Well, I don't want to be in the house when the house light's on fire. What did Trump do when he reversed the tariffs? The equity market had touched a bear market the night before. Tuesday night closed bear market territory. It only lasted, overnight. And bonds were just selling off until he came out and said, okay, 90-day pause, because he saw it all falling apart. An intelligent group of people would have seen that beforehand. An intelligent group of people would have said, hey, this sounds like a plan, and would have had far better execution. So somebody had said, Peter Navarro is a Harvard PhD. How can you say he's dumb as a bag of hammers? Oh, he's knowledgeable, but he's not intelligent. The world is full of knowledgeable and unintelligent people. Trump had the uncanny ability to assemble the greatest mass of unintelligent, knowledgeable people on the planet, all in one place. So this over here is what I think was their plan, is to say we don't want to hurt domestic consumption. We want a fiscal surplus. We need to fix that by either raising revenue or raising tax rates. Since we can't raise tax rates, let's lose tariffs. Let's just lie to people, tell them that it's something else, except everyone else heard them lie, unfortunately. And we'll say this part out loud as well. And I think this was the plan overall. However, given the backlash that's going on, given just the way that it was done, I don't think that trade deficit is going to get fixed, and I don't think the fiscal deficit is going to get fixed. I think they will continue on, but I do think they're going to lose exorbitant privilege, which means they're going to have to offer higher and higher yields to get people to lend them money. They have to stop talking about taxing capital. That conversation needs to end immediately. And somebody from the administration, preferably Trump, has to come out and say, none of that's going to happen. But then, who's going to believe him? Because how many times has he said that's not going to happen, and the next day he pivots and changes his mind? The cat's out of the bag on this one. The conversation's already started. Even if he says it's not going to happen, who's going to believe him? Because what we have are unintelligent, knowledgeable people. Are they going to know any better? So because of this, because of all of this, I feel that you got to get out of U.S. Treasuries. You got to get out of U.S. dollar. When I say out, I don't don't mean 100% out, but you do have to equal weight or underweight the U.S. at this point in time. I have been taking that opportunity with equities that on green days, I sell and I say, okay, I'm out of this, I'm out of that, that's good. I then redeploy that money into the Canadian market. I'm doing the same with treasuries now. I sold a bunch of calls on TLT at 88. They expired. I get to keep all that money, so when the market opens on Monday, I will take losses in my treasury position equal to what I earned selling the premiums. So I will reduce my position, and I will do it again. I will sell premiums on TLT. I will sell calls on TLT, and very short periods of time. We're talking 2-3 days at a time. I'm certainly not doing it month by month, but 2-3 days at a time. And if they expire worthless, I will take losses equal to that amount. And I will slowly start to move my allocation downwards from the position I currently have because I got a lot. I'm not going to zero on either my U.S. equity position or my U.S. Treasury position, but I'm certainly going to be moving it down a lot and moving into either euro-denominated assets or Canadian-denominated assets. I don't mind euro-denominated assets. One of the things that is sort of enticing there is the pivot from Germany to begin to spend money, a trillion euro. The European sovereign bond, I think, is a good idea to increase capacity. The European sovereign bond is a structured bond with a senior and a junior tranche, which then holds a whole bunch of the individual countries' bonds. So you just simply buy these bonds, and they're a collection of all the other bonds. So you don't have to say, well, no one single market has the capacity. There's not enough French bonds, Italian bonds, Spanish bonds, Greek bonds, German bonds. There's not enough. But if they were all wrapped up, much like mortgages are wrapped up into a mortgage-backed security, and you buy a bond that's backed by a whole bunch of mortgages, you buy a European sovereign bond that's backed by a whole bunch of the individual country bonds with a senior and a junior tranche. Now you have capacity. And if you're going to underweight, and allocators around the world are going to underweight, or even move from an overweight position to an equal weight position on U.S. Treasuries, they're going to have to go somewhere that has the capacity for it. And if they do that, just at the margin, if they do that, that will put downward pressure on the U.S. dollar and upward pressure on the euro. So I think that that's probably a good place to be. Another place to be would be the yen. The yen still has safe haven status behavior. You've seen the yen increase over this period of time. So I think as more Japanese investors pull their money from the U.S., that would probably continue as well. So I think this whole master plan idea is attributing intelligence to a group of knowledgeable people where intelligence doesn't belong. I think you have a group of knowledgeable people who are unintelligent, who, if you say A and B, could not determine that C would be the result, in which case, who knows where this goes, because you can't count on them to at least have the ability to put 2 and 2 together. Anyways, let's look at some interesting pictures. Okay, first interesting one I want to show you. I only have 2 screens here. First interesting one, I got this out of our Discord feed. We have a news feed which is crowdsourced. People from around the world say, have you seen this? Have you seen this? Have you seen this? And what a great news feed. But I saw this one graph which then led me to the longer story. Tariff shockwave leads to collapse in ocean container bookings. U.S. imports plunged 64% from March to April. And this is the last week of March versus the first week of April. So you have to put it in context. It's only those 2 weeks If you look at it from the beginning of the year or year over year, you get a different story. Containerized imports are down 20% since January. This is saying 64, only down 20% since January. They're still up 30% year over year. The first week of April representing 30% increase year over year, but it's just to show you the amount of front running that was done before the end of the quarter. 1 week, this is week over week drop in ocean bookings, comparing March 24th to the 31st to April 1st to the 8th, last week of March versus the first week of April. Global TEUs booked. TEU is 20-foot equivalent units. You know those containers you load on ships, the really long ones? Those are 40 feet long. So they count as two 20-foot equivalents. This is in 20-foot equivalents. Global, down 49%. Week over week, down 49%. But again, still up. These are containerized imports to the U.S. Year over, still up 30% just to the U.S. alone year over year. But so you can imagine what the front running was to get ahead of the tariffs for April 2nd. Overall, U.S. imports down 64%. U.S. exports down 30%. Imports from China down 64%. Exports to China down 36%. So those are some big drops, but again, it's just week over week. What we do have to consider is the M component in GDP, because our first quarter GDP comes out at the end of April. It's going to be from January 1st to March 31st. So if you had, during that period of time, all of this front running over here, the M is going to be very large, X minus M. That lowers GDP. GDP now has first quarter GDP sitting at negative 2.2%. That's including gold imports. If you take gold imports out, I think they're basically flat. And this is as of April 17th. They have it at negative 2.2. But this front running is not showing up in there, but it's certainly showing up in these numbers here to have that kind of drop off. Plastics, this is imports from China. Plastics down 45.4%. Copper down 31.1%. Wood products down 24%. Okay, I have two interesting things on this screen. One is a picture I took, and the other is a screenshot from YouTube. The first one, the picture I took, is in Barcelona. I'm downtown Barcelona walking around, and I see people selling stuff on the side of the road, and they're all holding, you can see these ropes. All of them are holding ropes, and each of the rope goes to a corner of the sheet that they have sitting down here. And I was wondering, well, what's that for? And somebody said it's when the police come, all they do is they pull up that rope, and it turns into like a carrying bag, and everything gets trapped inside, and they run. No way, look at that. They're all prepared for that. They all have these things, and then they have one person who's looking around, just looking around, and if they see someone, I guess they yell, police or whatever, and then they just pull this up, and all the four corners create a little bag, and everything gets stuck inside the little pouch, and then they run. Isn't that clever? This other one over here, I was watching CNN, because it was a story on Trump wants Powell out of the Fed. Waiting in the wings is Kevin Warsh. So I thought, let me hear what they have to say. This is what they had up. Trump again calls for Fed to cut rates and says Powell's termination cannot come fast enough. Now, this is supposed to be, journalism. You go to journalism school and you learn about journalism. Part of that is you learn English grammar because, of course, you're communicating. You want to get it right. That is a plural, not a possessive. But this is a possessive. Powell's termination cannot come fast enough. That is apostrophe S. CNN, I should not have to do this, is correct your basic grammar. This is a basic mistake. If you can't get this right, if your people are this intellectually lazy, how can we believe anything that you say on your show? How can we have any faith that anything you're saying is worth listening to. Come on, man. If you can't get the little stuff right, what are you doing with the big stuff? Anyways, that's it for this week.